In this video, I will talk about the use of ratios to analyze financial statements. A ratio is one number divided by a second number equals a third number. We monitor ratios in business for their feedback value. For example, when driving in a car, we constantly look at the speedometer. The speedometer is actually a ratio that we monitor known as miles per hour. In business, we monitor many ratios simultaneously. The goal is to keep the ratios within a desired range, never to maximize or minimize, but to keep them in a desired range. For instance, when driving on the road with a speed limit of, say, 70 miles per hour, we might want to keep our speed in the range of 68 to 75 miles an hour. Every driver has their own desired range. Likewise, each business will have its own goal range for each ratio. In this video, I will briefly introduce 17 common ratios that are used to analyze financial statements. However, in the real world, there are many more ratios that are used in business. I'll put these ratios into three groups: liquidity ratios, solvency ratios, and profitability ratios. Liquidity ratios evaluate a business's ability to pay its bills in the short term. That means in the next 12 months. Solvency ratios evaluate a business's ability to pay its bills in the long term. That means beyond the next 12 months. Profitability ratios evaluate a business's ability to generate earnings or make money. The current ratio is current assets divided by current liabilities. Current assets are cash, any asset that will be converted into cash within the next 12 months, and any asset that will be used up within the next 12 months. Examples of current assets are cash, accounts receivable, marketable securities, inventory, supplies, and prepaid expenses. Current liabilities are all the liabilities that will be paid within the next 12 months. Examples of current liabilities are accounts payable, short-term notes payable, and the current portion of long-term debt, meaning the next 12 payments of a long-term loan. The purpose of this ratio is to evaluate a business's ability to pay its bills within the upcoming year, or will the business need to borrow money to pay its bills in the next year. A variation of the current ratio is the quick ratio. The quick ratio evaluates a business's ability to pay all its bills quickly or instantly. The quick ratio is like the current ratio, except that the numerator only includes assets that can be converted into cash almost immediately. Quick assets include cash, marketable securities, which could be sold at the click of a mouse, and accounts receivable, which could be used as collateral or a bank loan. While we are here talking about current assets and current liabilities, I want to define a term that is technically not a ratio, but it is calculated along with the current ratio. Working capital is a measure of a business's extra cash that will not be needed to pay current liabilities. In other words, working capital is money or near money that a business can use more creatively for upcoming projects. The accounts receivable turnover ratio is used to evaluate how long it takes customers to pay their bills. The accounts receivable turnover ratio is calculated by dividing sales by the average accounts receivable. An alternative to the accounts receivable turnover ratio is the number of days sales in receivables ratio. Here's how the textbook that I use calculates it, but I prefer to calculate it a little differently. If you simply take the accounts receivable ratio and divide it into 365 days, you will get the same result. The inventory turnover ratio is used to evaluate how long it takes to sell inventory. An alternative to the inventory turnover ratio is the number of days sales in inventory ratio. Here is how the textbook calculates it. But again, I prefer to calculate this one a little differently. If you simply take the inventory ratio and divide it into 365 days, you'll get the same result. Next, I want to talk about solvency ratios. Solvency ratios evaluate a business's ability to pay its bills in the long term. There are 3 solvency ratios that essentially do the same thing, so only one of these ratios is typically chosen by an analyst to use. The ratio of fixed assets to long-term liabilities measures the margin of safety available to long-term creditors. Fixed assets are sometimes called plant assets or property, plant, and equipment. The net is a reminder to subtract accumulated depreciation. The ratio of liabilities to stockholders' equity measures how much of the company is financed by debt and equity. The times interest earned ratio measures the risk that interest payments will not be made if earnings decrease. An alternative way to write this ratio is to change the numerator to simply say operating income. The return on common stockholders' equity removes all of the preferred stockholder data from the equation. The price-earnings ratio measures how much investors are willing to pay to purchase $1 of this year's net income. In other words, the price-earnings ratio indicates investors' opinions about the future growth potential. The higher the price-earnings ratio, the more investors believe that future net income will grow.